I wonder how much of this investment, still going full out on equities, is just about that valuations still look attractive with us trading under a 20 forward times PE yet again, versus perhaps even if we weren't there and we hadn't sold off over the past 2 weeks, you would still be this bullish on equities.
Yeah, look, the thing that I love about equity so far in 2026 is that it's been earnings, not price, that has really kind of driven things. Like, look, everyone was concerned at the beginning of this year around multiples and around valuation. And this has been a recurrent concern. We continue to wring our hands as multiples have ground higher over the course of a number of years. But this year, because it's earnings and not multiples that are driving markets higher, and because the fundamentals continue to come in very strong, and we expect actually very solid reporting over the course of this week, that we feel more comfortable in continuing to add to positions, especially when there are bits of a pullback. I would note, though, of course, we've been in this trading range for the last couple months, and it's going to take a broader, array of investors to get comfortable with adding additional risk to really drive the markets up higher into year end. But we think that can happen as some of the worries that people have around geopolitics, inflation, rates, and AI sustainability fade.
Kate, I wonder how you're thinking about hyperscaler spending, NVIDIA spending, the circularity of it, and how this market is likely to continue to receive those numbers as we go through the rest of the earnings this week.
Look, I mean, amongst all the worries that we've had, again, over the course of 26, and this was sort of echo of the second half of 2025 as well, is this worry around, are companies spending too much? And if they're spending too much, how do we think about the return on investment? I mean, this is a consistent investor angst. What I will say, and we're going to get a lot of information about this over the course of the week, is we actually see no signs of any slowdown in overall Capex. We got that from Alphabet last week, and a very clear message that the increase in spend is because of demand, and that they're going to likely revise up their 2027 expectations for Capex and spending. But something I just want to highlight here, we focus a lot around the Capex in the AI and tech space, but actually overall investment in the economy is exceptionally strong. In fact, we got data this morning suggesting that momentum is very, very strong. So when we think about the investment cycle, it's not just AI and tech, but also the broadening out of the spending that's happening and how that's going to support both the macro and we think a widening array of fundamentals across industries.
So to what degree, though, is it outside of tech, Kate? Because the point has been made by Torsten Slok and others that it's an economy increasingly reliant on AI spend. Does the kind of figures you're seeing for this macroeconomy give you confidence that should we see a pullback on spending by some of these tech players, that this is an economy that will do okay and not slip into a recession?
Yeah, I'm not worried about the economy slipping into recession, but if we were to get either a pause, I don't think we're going to get a cut, but a pause in terms of overall Capex spending, I do think that would be another shock to sentiment. We monitor sentiment, very closely, as well as positioning. That's a big part of our process. And, our readings now suggest that actually sentiment has slipped further over the last 2 weeks. So we're in kind of this summer doldrums, again, cycling through these worries around AI Capex, geopolitics, inflation, et cetera. And I think, if we were to get any of these sort of shocks, whether it's around a broadening of the war or further challenges to energy supply, or the AI tech and Capex spending backing off, I think we'd see another hit to sentiment. But I don't think it derails the economy. I mean, that's the important thing. In fact, one of the things we were talking about earlier this morning is how strong the economic surprises have been, not just in the back end of 2025, but throughout the course of 2026. You can say economists maybe have been conservative, but you can also say that the data has come in much stronger across almost every metric, on consumer side, on business side, and that activity we expect to continue into the back half of this year. So a very strong macro backdrop, but sentiment could take a hit further if there was any sort of talk around pausing or stabilization in terms of the Capex landscape for AI.
Can we talk about that macro backdrop, Kate, especially as it relates to this week? This is a market that considers the meeting live from this new Fed chair, Kevin Warsh. What are your expectations, and could Fed hikes change some of your outlook?
Yeah, so our expectation is not that we're going to get a hike this week. Of course, it's not a zero probability event, and we see that, of course, getting priced into markets. A key message we've had over the course of this year has effectively been that inflation has been broad enough and persistent enough that even before the shocks from the Iran war, that the Fed was going to have to really consider more of a tightening bias rather than easing bias. And the market caught up and then sort of overshot on that front. And we think the most likely next move from the Fed is a hike, although the timing of that, again, doesn't seem likely this week. I think the important point here is when you strip out the energy effects, there is sort of broad-based goods inflation. And we are now overshooting the Fed's target for over kind of 5.5 years. And I think Chair Warsh made this very clear in the June commentary and during the presser that they were very focused on that 2% target. And so I think it's unlikely that we would get any type of easing, but the tightening starting as soon as this week is not a high probability event in my mind.
Well, perhaps what Kevin Warsh needs to do is bring the long end down. He's concerned about the housing market and about financing. And this is a long end that has been drifting higher. Kate, for the 30-year yields, we are above 5.1%. Real yields are also incredibly high. Just for the price of a 30-year yield, it's been above 5% for the longest streak since 2008. Should that be impacting, or has it even been impacting risk assets at this point?
We've seen the relationship between bonds and equities actually break down considerably. And it's one of the reasons why we've shifted a little bit of our portfolio construction to look for diversifiers. Because, our expectation is that yields, particularly the long end, will stay elevated. I don't know that we get the 10-year creeping up to 5%. I think that's a psychologically important level, and people would likely be buyers at that point. But that the long end will remain elevated. And against that backdrop, we've also seen bonds not perform the way that we would historically want them to perform in periods of shock, right? We've had equities down and yields up in a couple of these shock moments, which also leads us to believe that we need to, really rethink our portfolio construction. One thing I would also note is we've heard a lot of officials and pundits discuss, the impact that these higher long end yields are having on government funding. We know the deficits are going up in the U.S. and around the rest of the world, and that's something that governments are really going to have to grapple with. To the extent that, the Fed and politicians discuss wanting to keep the long end anchored, they can try and jawbone it, but if the market is concerned around overall spending and the persistence of inflation, I think it's going to be really hard for them to do. So we've remained very short duration in terms of our portfolio. And, I see very little reason to add duration in the near term.
Kate, the difference in correlation between fixed income, government bonds, and equities, can we extend this conversation to corporate bonds? Because later we're going to be talking to Carlyle's Akil Bansal, who oversees asset-backed financing, and is basically making the pitch that traditional fixed income corporate bonds don't give you diversification anymore. A 60-40 portfolio doesn't work because of all the tech issuance and just how highly correlated equities are now to credit. Are you seeing the same concern? Have you rethought at all about the place for traditional fixed income, specifically corporate credit, in a portfolio now?
Yeah, we prefer to take our risk in equities over credit at this point. But of course, that doesn't mean we have got rid of all of our credit exposure. The one thing I would flag here, and this is an important one, is, I was making this point around valuations compressing over the course of 2026 as earnings have outpriced the price movement. But that has not happened in the credit space. Spreads are still incredibly tight. They're trading close to their 15-year tights. And there's been a little bit of a disconnect between the equity and corporate credit environment. So here's what I would say. You have to be very thoughtful, too, about where you allocate in credit, because spreads remain really tight and don't reflect, the same types of, concerns that equities have reflected. And that, you're right, there continues to be some more overlap in terms of the sector exposure and the thematic exposure that you may be getting in credit. We're not at a point right now where we would say this is concerning. In fact, we think some of the companies that are issuing corporate credit are actually very high quality, and it can be, an interesting part of your overall credit portfolio. But it's something that bears watching. And as the tech and AI related credit becomes a larger percentage of the overall market, we will have to ask ourselves, how much overlap are we comfortable having between our credit and our equity exposure? But still biased towards equities over credit at this point.